Yeah, so we tend to have broadly diversified kind of institutional portfolios similar to what you would see in a pension fund or a college endowment fund, right? I would say the vast majority of our clients tend to be somewhere between 50% and 75% stocks, depending on what their risk profile is and how long until they retire. And then again, some of it comes down to, how much surplus do they have? Sometimes they'll leave some of those surplus assets that they don't think they're going to need invested more aggressively so that portion can grow and become an inheritance to their kids and grandkids, right? But so as you take a look at it, if you were to look at a 60% stock kind of target portfolio for us, it would probably be about 40% US stocks, split kind of equally between value dividend stocks and more growth stocks, with some mid cap and small cap in there. It would probably be about 20% um, international, developed international, and emerging market stocks. So developed would be like Europe, Japan, Great Britain, that kind of stuff. And then the emerging market stocks being more maybe Middle European, South and Central America, Southeast Asia, and so forth. And then the other 40%, and this is where there's been probably a little more evolution over the last 5 years in our portfolio, and that 40% that would typically be in bonds, we've kind of evolved that to where it's probably more like 25% bonds and the other 15% we're using bond like alternative strategies, things like merger arbitrage funds, market neutral funds, things that give you bond like return and bond like risk characteristics, but also don't have the same interest rate and inflation risk. Because when we went through post COVID, right, we went through this period where inflation in the United States went from years and years where it was under 2%. All of a sudden, inflation in 2022 and 23 shot up to 1%. And then the Fed had to start raising interest rates aggressively. Well, when the Fed raises interest rates, bond prices go down. So if you have 40% of your money just sitting in bonds, you're going to get clocked you're going to get hurt on the other side of that. So we started making adjustments on that side. And we typically target a dividend yield out of our portfolios of somewhere in the neighborhood of 3.5% to 4%. So that, if we're taking a 4% withdrawal rate from our portfolio, we can fund most of that from the dividend side of the portfolio without having, and that dividend is a combination, or that distribution rate is a combination of dividends from the stocks and interest on the bonds.
Okay, so you make sure the portfolio still grows, and that this 4% that somebody plans to take out in their retirement is then actually funded by those dividend-paying stocks or
Exactly.
income-generating assets. Do you see in general that bonds get a bit less interesting? I mean, it's for centuries it's been uh, a key pillar of most portfolios, but nowadays with so many new products coming up, new asset classes, do you see in general there's a trend towards like using less bonds?
Well, yeah, and like I said, I like in our scenario, we're using less bonds than we did before because of some of those alternative strategies.